Oracle is trying to borrow $56 billion to build out AI data centers. And we just have this. This is breaking news today. The banks are betting against them. First off, how do you even fund a $56 billion deal? And the answer is, at that size, you don't get your funding from just one institution. You actually get them from a lot. So it went out in tranches. So we have a $38 billion tranche for Texas and Wisconsin data centers. That's through JPMorgan. There's also an $18 billion tranche for New Mexico. That's through Blue Owl Capital. And this is basically a syndication model. So what that means is JPMorgan may lend that $38 billion tranche. And then what they do is they sell other parts of that loan to other banks to diversify the risk. That way, if Oracle goes completely under, they're protected. They don't owe the full $38 billion. Other banks own some of that risk as well. By the way, this is the largest data center debt offering in history. So as far as lending goes, Oracle has a BBB rating from S&P. That's the same tier as Johnson & Johnson. Simply put, that's like having a good to excellent credit score as a private individual. They are known as somebody who pays back their debts in a timely fashion. But despite this fact, they are paying loan rates that are closer to a company with total junk credit than a household name that has a BBB rating. And in fact, some of the bonds going around are trading at 75 cents on the dollar. Ouch. And to understand this whole mess we're in, bear with me here. You have to understand credit default swaps. And I know your eyes just glazed over. You're saying, I'm not going to get it. I don't understand. I can explain it to you very, very simply. So just bear with me. This is one of those concepts that finance people don't want you to know. They want you to think, oh, I'm just too dumb to understand, so they can get away with this bad behavior and this gambling. And you are none the wiser to pick up on it or to call BS on it. But I'm going to explain it to you very, very simply. So bear with me here. Imagine you're a kid and you're friends with Timmy. Timmy is going around to borrow lunch money to build a treehouse. In that situation, a credit default swap is basically insurance on that money lent out. If Timmy fails, you get some kind of a payout to compensate for you. If Timmy can't pay back that lunch money, if his project doesn't pan out, that credit default swap hedges against your investment. You get some money back. But here's where it gets really interesting. You don't have to be one of the kids that lent your lunch money to Timmy to buy a credit default swap. That's called a naked credit default swap because you don't actually have the underlying security. You're just buying the swap. And you would want to do this if you were actively betting against Timmy to fail. Let's say like you have good insider information on Timmy. You know, he never finishes a project. He can't deliver, and you want to bet against him, but you don't have enough capital to invest and do a credit default swap and have the insurance. You might just buy the credit default swap to bet against him if it's such a certain thing for you. And yes, this is betting. And yes, before you ask, this is totally legal in America, despite the fact that this is one of the main things that contributed to the 2007-2008 financial collapse. So in case you didn't pick up on it, in that example, Oracle is Timmy, and instead of a treehouse, they're building a bunch of AI data centers. And at this point, a lot of people on Wall Street are thinking that Timmy maybe bit off a little bit more than he can chew on this one. And what a lot of people on Wall Street are doing, this is breaking. We're seeing a huge uptick in this lately, and especially today with some of this breaking news, is a lot of investors on Wall Street are now starting to buy naked credit default swaps against Oracle. So they are betting on Oracle to fail. And so when you hear this jargony BS that Oracle CDS spreads are widening, that just means that the insurance is getting more expensive. It's like how fire insurance would go up if your house is starting to smoke a little bit. But this is the part that should make you really uncomfortable. Banks like JPMorgan are playing this from every angle. They loan out the money, but then they are also buying credit default swaps to protect themselves. So they're now hedging on this bet, which if the dude that lent you $34 billion is starting to think something might be up here, that spooks me a little bit as another investor. And they're profiting every which way. The banks are winning in every direction, no matter what happens. A lot of desks at the same bank, at JPMorgan, at other similar banks, are also selling credit default swaps against Oracle because everybody wants in on the action. There is a ton of demand for these naked credit default swaps against Oracle right now, which means a lot of Wall Street is betting against Oracle. Some figures on that for you. Oracle credit default swaps are up 310% since June. They've reached the highest level since the 2008-2009 financial crisis. CDS trading volume on Oracle is up 650% year over year. So this is not also like a normal thing for Oracle. This is a deviation from their norm. And get this, Oracle is now one of the top 20 most actively traded corporate CDS names. This is so common right now that traders are calling it the AI bust hedge. So when your debt is trading like junk, you got to put all of the options on the table if you're Oracle. And that's exactly what they're doing. Let's run through the main ones. TD Cowen reports that they're looking at 20 to 30,000 layoffs, which would free up $8 to $10 billion in cash flow. Certainly not going to help those data centers get built faster, though. They're considering selling Cerner, which is a company they acquired for $28.3 billion in 2022. They already cut 10,000 jobs at the end of last year in 25. They have a new customer policy. This is how you know the company's really in deep trouble. They're now requiring 40% upfront deposits. So if you go to buy their compute service, they are gonna need 40% of that upfront so they can invest it, spend it, and then never pay it back because they'll be out of business before the contract comes due. And they're raising $45 to $50 billion through debt and equity dilution, which is the real head scratcher to me as somebody who's not on Wall Street, is why is a public company that is profitable taking out debt? It's such a massive rate. And above all that, Oracle is in this mess in the first place because they got into bed with con man Sam Altman. They are in a $300 billion contract with OpenAI, which, by the way, as a company, as I've mentioned before, is not profitable. They are not profitable. They are not projected to be profitable until 2030. So you have a company with a BBB rating that is being treated by Wall Street like it is about to collapse, all because the AI infrastructure build out was a house of cards that is now toppling. And Wall Street is putting their money where their mouth is. They know that this is failing now. They know that the bubble has popped and they are trying to eject before the normies find out about it. If you want more technical due diligence on your tech companies and financial analysis from somebody who's actually been in the room where a lot of these decisions get made, please subscribe to the channel. We're trying to scale right now. The algorithm has not been very friendly to us on YouTube for getting out to new viewers. So if you could share this with a friend, I would really appreciate it. The only way we're going to scale is through word of mouth. Thank you so much for watching, and I look forward to seeing you in the next one.